We're going to divide that by 12, and we'll, okay, 3 months have expired, not 1 month. So let's do this in a calculator first of all. So we've got the 1860, and if we divide that by 12, we get a monthly total. And it's telling us now that 3 months have expired. So it would be 155 per month times 3 would be these 465. So let's do this calculation again. I'll just delete this and we'll calculate it. Equals the 1860 divided by 12. That would give us a monthly total times 3 months that have expired, and enter. So that would be the formula. And then if we post this out, we can then go here to the prepaid insurance equals, kind of scroll down to the credit, and the insurance asset will go down. That's a debit, that's a credit, opposite thing to it, making it go down. And then we're going to go down to the insurance expense equals, and we'll go up to the debit here, and that's going to make this go up in the debit direction, put us back in balance, bring net income down. Okay, so then let's take a look at C here. See here. Okay, so as of 12/31 has not been paid for 4 days of the work week. Okay, so again, let's take a look at the transactions and just, we're talking about wages or pages or payroll of some kind. So let's take a look and see which accounts would be affected. So if we go through our rules, we know that there's going to be a balance sheet account, which is not cash, above the blue line, related to wages of some kind. And if we look through them, and I see a wages payable, so I'm going to say that's probably one of the accounts we're going to mess with. And once again, this is great to have the trial balance open in doing these problems. And then I'm going to do something to the income statement account below the blue line, below equity. In that case, it looks like wages expense. So these are the accounts that will be affected. If we look at the expenses, they all have debit balances. They only go up in the debit direction. To make something go up, we do the same thing to it. So in this case, we must be debiting wages expense. I'm going to debit wages expense. If we debit that one, we must be crediting the other one. So once again, if we go through this process, we can see which accounts are affected and which way they are going without really knowing what is happening. So now let's talk about what is happening. And if you were wondering there, I accidentally posted the wages expense up here. So this should be wages payable. Wages expense on top, wages payable here. This is wages payable. Okay, so then what's going on here is that if we're trying to get things correct as of the cutoff date, which in this case is 12/31, then if we're thinking about payroll and we think about it in terms of the simplest payroll would be we pay it every week and maybe we pay it on Friday. If the payroll, the end of the month doesn't land on Friday, then we're going to have a few days that people have worked in which they haven't gotten paid. So we basically calculate payroll more or less on a cash basis or when we run the payroll, and that makes sense because it would be too complicated to be on a perfectly accrual basis. But as of the date that we want to create the financial statements, we want to be as close to a perfect accrual method as we can. So in this case, we're saying that 4 days have expired. So maybe the 31st landed on a Thursday. That means that they're not going to get paid till Friday, the 1st of next year, the next time period. But people have worked 4 days this time period. And we need to recognize the expense when the expense incurred, when it happened, even though we're not going to pay it till next month. We need to pull that expense in this month, even though the payroll is not going to be run until the next day, the next month. So if in order to calculate that, we're going to say that we have, D says 4 days, so it's 115 per day. So we'll say this equals 115 times 4 in this case, and that will be the 460. That's going to be the debit and the credit. So if we post that out, what will happen if I'm going to do the wages expense first, wages payable first, and so I'm in cell M16 equals, going to scroll to the credit here of 460. That'll bring the liability up, meaning we owe these people money that we're not going to pay until Friday, the next day. Enter, and so the liability went up in the credit direction. Then we're going to go to the wages expense. There's something in there, so I'm going to double click on it, go to the end of it, plus go to the expense. So that's an expense. This expense is going to bring the expense up, brings back in balance, it's going to bring net income down. So there we have that. And then we're going to go to D. Let's see what D says. D says the computer system acquired on October 1st is expected to have 4-year life with no salvage value. Okay, so we're talking about computer equipment, so let's think about what accounts will be affected. So remember our rules for the adjusting process. There's going to be a balance sheet account that is not cash related to equipment, and you might be saying, well, that's going to be office equipment. But in this case, it's going to be the account related to it, because we're not going to write down the equipment. What we're going to do is write down the related account. So it's a little bit tricky in our process here. We're going to say it's actually the accumulated depreciation related to the office equipment. And what are we going to use in order to write that down? Actually, it's the computer. They did the computer equipment first. So let's do the computer accumulated depreciation related to the computer equipment. And then what's going to be the income statement account down here below the line related to equipment and the depreciation of equipment. And that's going to be the depreciation of computer equipment. So there's the two accounts that will be affected. This account is a expense. Expenses have debit balances. They only go up. So how do we make something go up? We do the same thing to it, which in this case would be another debit. So we're going to debit the expense. Therefore, we must be crediting the other account, which happens to be accumulated depreciation. And then I pasted it again. So I'm going to copy that and paste it here. So once again, we can see which way the accounts go without really knowing what we're doing. Now let's talk about what we're doing. So the computer is on the books for $20,800. When we bought the computer, we credited cash, we debited computer. Why didn't we debit computer expense? Well, because under the matching principle, we need to match the use of the computer in the same time period that it has helped us generate revenue. This computer hasn't helped us generate any revenue yet. We just bought it. We're going to use it throughout the future. As we use it, we're going to allocate and expense this item down here, similarly to the way we did with the supplies account. But unlike the supplies account, the computer equipment doesn't actually physically go away. The computer equipment, we can't count the equipment and see that we have less equipment. It's still there. It's just that the value is depreciating. So we don't want to directly write down the computer equipment for that reason. We want to tell our readers two things. We want to tell our reader what we bought it for, and we want to tell our reader how much we have written it down for. Therefore, we broke the T account into, like, a 7 and an R. And so that means that this is like the second half of the T account. This is the debit side. This is the credit side. We're writing it down, but because we want to tell our reader these two things at one time, that's why we're doing this depreciation. So the calculation is going to be, if we're thinking of it as a straight line, they didn't tell us straight line depreciation, but that is the assumption. We're going to say that we have 28 here minus, they had to salvage, no salvage, with no salvage, and then divided by how many years do we have? The computer equipment acquired in October is expected to have a 4-year, so divided by 4, that would give us the yearly total, but we bought it in October, so now we need to bring how many months in the year. So I'm going to divide it by 12. That means we have 433 months in the year, and then we have October, November, and December, because we bought it in the 1st of October. That's 3 months for this year that we've had it, so times 3, and that gives us 1003. So let's think about that calculation again. So we'll say equals, and we purchased it for $20,800, divided by the number of years in the life. It says there's 4 years in the life of this asset. That would give us the amount per year. And now we have to get a fraction of a year. So then I'm going to take that amount, and I'm just going to divide it by 12. And so divided by 4 years, divided by 12 months, that would break down to how much per month. And then we're saying that 3 months have expired. Why? Because we have October 1st, so that's all of October, November, and December. So times 3, and that gives us the 13. So we're going to debit and credit that amount. So if we go over here to cell M14, say equals, and scroll down to the credit and accumulated depreciation, that's going to make this go up. Now notice this is a contra asset account, meaning it's an asset, but it's the second half of the T account, remember? So this is the debit side, this is the credit side. That's why you get a contra asset. And why do we do that? Because we know what we bought it for, minus this amount that we depreciated. It gives us the 19.5, which is the book value. Then if we go down here to M22 equals, and we go to the debit, that's going to make the debit go up, put us back in balance, bring net income down. Okay, so now we're on E. And E says the office equipment acquired on December 1st is expected to have a 5-year life with no solvency. Okay, so this is going to be the same transaction, but now we're going to be doing it with the office equipment. So here's the office equipment. We're going to depreciate it. So I'm going to highlight the depreciation. We're going to depreciate it. And then the income statement account, once again, will be down here. And it's going to be the depreciation expense for the office equipment in this case. Expenses all have debit balances. They only go in one direction, up in the debit direction. Therefore, we're going to have to debit the expense, and we're going to have to credit the accumulated expense for letter B. Now we'll do this calculation again. Let's do it with a calculator one more time, and then we'll do it within Excel. Sometimes it's easier to think about these calculations with a calculator. So this, we can see that we bought this for 8.4 is in there. Office equipment October 1st, having a 5-year life. So I'm going to divide by 5, and that'll give us our yearly total. Now we need to break this down to how much per month. Therefore, I'm going to divide by 12. We have 140 per month. How many months has expired since we bought it in this time period? October, all of November, all of December, times 3 will give us this 420. Okay, so let's do that over here. We're going to say this equals the 8400 divided by the number of years, which is 5. Then we're going to divide by 12 to bring it to a monthly total times 3 months that have expired. Okay, 420 debit and the credit. If we post this, I'm going to post this side first in cell M12 equals the credit. That'll make the credit go up. Once again, it's a contra asset. That means the book value went from 484 minus the 420 down to 4980. And we're depreciating it, meaning we're expensing it out now, hopefully in the same time period as it helped us to generate revenue in accordance with the matching principle. So there's the debit. That's the debit. That's going to make the debit go up, put us back in balance, bring net income down, because income is calculated as income minus expenses. Okay, last one. We are on letter F. 3 of the 4 months prepaid rent has expired. So I'm going to go through the questions once again for the adjusting process. We're going to have an account above the owner's equity in the balance sheet, not including cash, for, in this case, prepaid rent. So if we look through here, there's prepaid rent. So we're probably going to be doing something with that account. We're going to look for an account dealing with rent down here in the income statement, and we have a rent expense. So we have this account here. And we know that expenses only go one way, they go up. Expenses all have debit balances, therefore we must be going up by doing the same thing to it, which in this case would be another debit. Debits go on top. Therefore, we must credit the other account, so this must go on the bottom. So once again, we know which accounts are affected. We know which way they're going without really knowing what we're doing. Now let's see what we're doing. Prepaid rent, what is it? Why is it there? It's an asset, because it's in the asset area. And what happened here is we paid rent, so we paid in credited cash, but then we debited not rent expense, but an asset, prepaid rent. Why? Because we prepaid it. We paid the rent in advance. So this could be, you can think about like a security deposit would be in this case, or if we paid like 6 months in advance, we would have to pay prepaid rent. And in so doing, then we would recognize the rent as we use it rather than when we paid it. So we got to write this amount down, and that's why we're going to credit prepaid rent and expense it down here. So we have 3 months. 3 of the 4 months prepaid rent has expired. So let's think about that. We've got 2940 divided. Let's bring it down into a monthly total by dividing by 12. That would be 245 per month. And we're saying, sorry, 3 out of the 4 months prepaid rent. I'm sorry, let's do that one more time. We've got 2940 divided by, they're saying 4 months total is what's represented by this number. So that gives us a monthly of 735. And we're saying 3 months of those have expired. Times 3 gives us the 2205. So let's think about that again. We're going to say equals the prepaid rent is 2940. Divided by 4 months gives us our monthly total times 3. Okay, so let's post this out and see what happens. We go to prepaid rent in M10 equals, we scroll down to the prepaid rent. That's a debit, that's a credit. It's going to make the debit balance go down. And then we're going to scroll down to the rent expense in M25 equals, we're scrolling over to the expense, that's going to make the expenses go up, put us back in balance, bring net income down. So now what we're going to do is we're going to take these ending trial balance numbers and we're going to make the financial statements from them. So we're going to take them from a debit and credit type format and we're going to put it into a financial statement format. So we're just going to be using the numbers on this side here. So we can see that the accounting equation is in balance here because of total assets